All right, hey, what's going on, everyone? Today we are launching a new series here on the Predicting Alpha channel that I'm really excited about. The idea is pretty simple. We're just going to be doing live trading together. And in particular, we're going to be talking about earnings trading for the next little while since earnings season has kicked off. And if you're new to the channel, by the way, just so you know, we focus on option selling here. Predicting Alpha is a private platform for 1,000 retail option traders where we focus on boring strategies that actually make money. We're not out here trying to do some crazy forecasting of what's going to happen to GameStop in the next week. We just sell volatility on ETFs and sell volatility around earnings events. Why? There's a risk premium there. We look to harvest it. It's really not that complicated, but at the end of the year, number in account should go up, and that's really what the goal should be, right? So the reason we're doing this is basically to showcase how things are going with the strategies. There's a lot of awesome stuff happening at Predicting Alpha. A lot of great things in the community, and I don't think we should be keeping all of that behind closed doors. So my goal with this series is really two things. Number one is if you're a relatively new option seller or you're just starting to get into earnings trading and selling vol on ETFs, hopefully you learn a lot from this series. I'll be walking you through my entire thought process. You're probably going to see me, have losing trades and talk through how those are going, winning trades and how those are going as well. I'll talk through all of it. And ideally, if you're new, you learn a lot. And in a perfect world, you learn a lot and you actually realize that one day Predicting Alpha is the right fit for you. This is a private community just for option sellers who are taking the game really seriously and want to focus on the things that are actually making money. So we have only 1,000 spots for members. We're trying to build a tight-knit community, and maybe one day that's the right fit for you. So that's my goal with this series. Obviously, we have that there, but really, we're just going to be chatting trading a few times a week. So why don't we just jump into it here, and I'll give you an idea of how things have been going so far with the start of the earnings season, and we can chat about some of the trades coming up tonight that I'm going to be taking. So first of all, we've been in the earnings season now for about a week. I started trading it on October 15th. Since then, I've taken 12 trades, with 9 of them being winners, 3 of them being losers. The account's up, a couple $100 here. Not bad for just a little start to the week. I guess to give you an idea, the account that we are trading with the PA community is about 40,000 Canadian dollars, I think. So, we're aiming for pretty small variance on a day-to-day basis. And we're actually going to be trying to take just a lot of trades here. So rather than piling in on, 1 or 2 earnings trades that look really great, I'm actually going to be looking to diversify across a lot of trades. So the way you can think about how we run this earnings strategy is we start off with the assumption that we're going to take every single trade. And then based on a couple different factors, we start to whittle down that list. One of them being liquidity. So we want to be trading things that we can actually get in and out of. The second one being the size of the underlying stock. Right? If the stock's trading at $1,000 a share, probably not something the account is able to handle. We need to be able to absorb any blows that can happen. So we need to be really careful about the minimum size we can even take on each trade. And then the third thing we sort of look at is some stuff related to how the back test looks for earnings. So I look at things like the implied versus average move around earnings events. I'll actually analyze the shape of the back test, looking to see basically a lot of small winners and the occasional big loser. And as we do analysis together, we'll be able to get into that. And then I'll actually do a event by event breakdown of the implied move versus how much it jumped in the morning, because that's really what we end up trading a lot of the times, is that difference between what the market thought would happen and how much it moved right in the morning. So as you can see right now, overall we're up a couple $100. The variance on each trade is pretty close to, +1, -1. I do expect that over the course of this season, we will take some pretty big, losers. It's the nature of taking so many earnings trades. But what you'll end up seeing happen here is, ideally, fingers crossed, when you make money this earnings season, is all of these small winners will outweigh the big losers and will come out with a profit. And that's the nature of option selling, right? That's sort of the way the game is supposed to work. Now, by the way, one thing I'll share with you, it's not out yet, is tomorrow or maybe later today, I'm releasing a case study on earnings that is basically the last 2 years of what we're doing together. I got the data courtesy of one of our members, Jay Trades Options. Shout out to Jay. Jay meticulously tracked all of his trades for the last 2 years. It's about 1,380 trades. He made 250K USD, and it's about 100% return there. He tracked everything. We did a little interview together, and I'll be publishing that, and I'll link it in this video once it's out. And that'll give you a really good idea of what the long-term plan for earnings can kind of look like, and then we'll do it live together here. So if you have any questions about what you're seeing here on the journal, anything that you maybe want to see that's not here, feel free to leave a comment on the video. I'll be happy to do that. And if not, why don't I just show you some of the trades for today that we're looking at. We'll do a quick analysis here of maybe 2 trades, and then future videos we'll focus more on the trades. So the first one on the list here is just Coca-Cola. I have basically this list here, by the way. We're in the PA terminal. It pulls all the tickers that have earnings either today after market close or tomorrow before market open. And then you can sort of customize this as you see fit. I basically have it right now set up so that it's sorted by the earnings short straddle return. I want to trade things that have made money in the past. So Coca-Cola is at the top of this list here. If we open the analysis for Coke, this is what we see. So it's tomorrow before market open. And we can kind of just walk through the story of earnings by looking at this page. It's not going to sound very magical by the end of it. So I don't know if, hopefully you're not expecting some like insane revelation and that'll be super exciting. Really, remember, we assume we're taking this and we're just looking for reasons to disqualify it, really. So let's walk through this story, right? So Coca-Cola has earnings tomorrow before market open. And the market is basically implying that it is going to move up or down 2.41% around on this earnings event, right? So tomorrow, market says stock will be up or down 2.41%. But when we look at the last 4 years of earnings, we see it's actually on average up or down just 1.15%. The difference between the two being sort of what we aim to capture when we are running this earning strategy, right? The difference between the implied and realized move tends to be like the risk premium or what we can call the risk premium around the event. The biggest move we've actually seen has just been 2.8%. So that can give us an idea of how much of a, risk we've seen historically. It seems like the market's really good at forecasting Coca-Cola moves. So it would take a big surprise for a massive move. And on average, the straddles yielded almost 25%, basically 25%, which is epic. Just with that alone, I'm already like, yeah, this is probably a trade we're taking. If we look at like an actual visualization of the back test around earnings, this is almost exactly what I hope to see, right? It's just like line go up to the right. Selling options has made money here pretty consistently. And that's what we, love to see. So, right, if we look at the individual returns, pretty much on every event, we've made money. We had one losing event where there was a 20% loss on the premium, and that's, pretty much in line with things we've seen recently, right? And so there's really no major cause for concern or major cause to size down smaller than we typically would. And if we take a look here, comparing just the implied move against the realized jump, which is a little bit of a different analysis, right? So if we think about this short straddle back test, what we're doing here is we're looking at the implied move versus the realized move. Implied move is like, obviously, how much it's expected to move around earnings. And the realized move is how much it moves over the whole next day. So we sell a straddle, market's closed, stock has an earnings event, market opens, the stock moves a bunch, and then the rest of the day happens, the day ends. That is the point in time where we're measuring for the back test because it's the most consistent. But we maybe want to also think about what happens right in the morning, since, between what happens right in the morning and close is where our trade really takes place, where we close out our trade. So we can see here that, for pretty much most of the events, the realized jump is smaller than implied, but we do see a few times where it is a little bit bigger. So, my level of confidence in making money on this goes down slightly because even though the realized moves here, there's only one that's actually bigger. when we look at the realized jumps, there's a few, and that's okay. It's just something to keep in mind. I also have a little bit of recency that I consider. And so in recent times, in the last year, let's say, there's been one event that has been a bigger realized jump than the implied move. So, there's nothing major cause for concern here. Like it's not like the last 4 events have all been like blowout events or anything of that nature. Things look pretty straightforward here. So yeah, that's pretty much the extent of the analysis I'm going to do today. You can use these graphs down here. This is the main story, really. So that's what we're going to focus on. We can do one more trade together here. Let's come over. Just by the way, something to mention, the first 2 things we talked about that we look at, it's the price and the option volume. So we have those just like right on the scanner for you as default. You can add more customizations as you need. But like, for example, let's say we looked at LAD, right? If we click into it, we go, oh, wow. LAD, this is another really awesome looking trade, right? Implied move at 6.5%, average move at 3.84. This is really sweet. But 2 things that I would keep in mind. So given the size of the PA account, a $300 stock price is a little too big because there's only so small we can make each of these trades. And at a $300, price, this straddle is going to cost like $20 or $25. That's a very big position for an account. That's like, the margin on that's going to be like half the account or something. So we're not going to be putting that on for that reason, because if we put this on, right, there's like 50 potential trades that we could take today, right? And they all have a positive back test. They all kind of have the potential to be something we take. If I put that on, that's like 4 trades that I can't take, 5 trades that I can't take in its place. And a big part of earnings is diversification, being able to take multiple trades. So immediately I would be like, Lithia looks really good, but we're not going to be taking it. But a second reason that we wouldn't take it today is because the average option volume is 60 contracts a day. Right? It's like not there. The 4-year median option volume is 300 daily contracts. Like there's just no volume. And for that reason, we would not be taking this trade, even though the back test looks pretty good. Yeah. Let's see here. I think STX was another one that I pretty much was like, okay, yeah, this is probably one that we're going to take. I took a look at this. When I first looked at it, walking through the story, it looks good, right? Implied move 6.5, average move 5.3. Not quite as big of a spread as we saw with, some of the other trades with Coca-Cola, for example. Average straddle P&L is about 12%. This is a lot more in line with what you would typically see. A max move at 11%. This is all pretty much standard looking. One thing that I didn't love at first was this idea that the P&L here just chops back and forth, right? You look at this and it's like, okay, every other event is a loser. Why would I take this, right? Does the market even know how to price vol around this trade? But I do have a little bit of that recency bias that I lean into. And I look at this and I say, okay, it looks like maybe there's been a change maybe the market's kind of figured out what matters for this company a bit better. And now the last few events have been a pretty reasonable risk premium that's been able to be collected. So I think that would allow me to continue to include it in the portfolio. So it's likely one that I'm going to place today towards market close and include in my portfolio. And what I'm doing with you all here right now, just walking through this analysis, this is basically what I'm doing for all the trades today. There's obviously a component where I then go and I look at the option chain. For example, with STX here, we can see the option volume says 3.3K. It's a decent enough volume, right? I'm trading like a 1 lot or a 2 lot at the most. So I don't need a huge amount of liquidity to get in and out of these trades. But I have to actually look at the chain itself and see what the spread is, right? If we can't actually, we have to get into this trade and we got to get out of it tomorrow. So if the spreads are too big, we're basically giving up all the edge on that. And over a long number of trades, that will really hurt us. So I'll have to actually go look at the chain towards market close and see what we can find. I might end up doing a straddle or a strangle or just changing my strikes to try and make it work, or we might end up passing on it. We have to go and take a look at the chain. So everyone, that's basically what this series is going to look like. We're just going to chat trading. I might include some stuff about the ETF strategy we're running. I am really curious to hear what you want to see in this series. We can really make it whatever we want. I would love to engage with you all a bit better. If you have questions for me, you want me to help you kind of take a look at some stuff, feel free to drop the questions here. Even if you want to just chat about, you have questions about some topics related to option selling, I've got a huge amount of resources that I can link to you. So feel free to leave those comments. And we will see you in the next video, right? We're going to probably post Thursday or Friday this week, something like that. I'll make another video like this, give you guys some updates on how the strategies have been going, chat about some more trades, the usual. So, all right, everyone, take care and happy trading. We'll talk soon.